Frustration. I'd be lying if I said that I hadn't been getting frustrated and letting my emotions just run the whole gamut of things over the last few months. I know it's been a difficult time. We've had systems that, had great long-term track records. They've been on a pretty hot streak of late, and all of a sudden they started making a series of bad trades. Even worse, we had systems that are supposed to not be correlated. The numbers bear that out. Our history shows they don't have much correlation. They all kind of went the same direction at the same time, both up and down. And very frustrating. Trust me, I'm here making the trades. I'm here watching the performance every day, and I know it's very frustrating. When you expect something to happen and then it doesn't, that gets be frustrating. I expected a lot of this to start happening. Some of the events unfolding, this year in the market, I expected to happen. And then I also expected our systems to be able to get out of the way. But that's the way the markets work. I've learned early on in my career, I heard others say it, that the stock market tends to make the most people possible frustrated. And it's certainly doing that to us now. Now, unlike other managers that are using subjective judgment, you don't have to worry about my emotions determining the outcome of what happens next, because that's really the question. The losses are here, we're where we're at, what happens next? And to do that, we have to really look at the expectations and the experiences that we have, and then learning a little bit more about our emotional biases to know of some of the mistakes that we might make. So let's look at the small picture, if you will. And this is a chart showing our performance along with our benchmarks, and then the dashed gray line is S&P 500, because as we mentioned in our last update, a lot of clients use that as a benchmark, whether it's to evaluate bonds or stocks or whatever. That's what the media puts out there, so that's what people use. There's a few things I want to understand when we look at this chart. First of all, a large majority of you that are advisors and clients didn't come to us until 2010. We were a very small firm. We chose purposely to not spend a lot of our money marketing. We didn't have any marketing expertise. And it took a while to get that going when we hired Tim McCain and Jim Stover in 2006, right at the peak of the bull market. Unfortunately for them, they started at a time that, similar to now, was quite frustrating to be doing active money management, and especially to be out there selling it. So with that in mind, let's look at just the experiences that our clients have. By design, our systems will underperform in a bull market. And since 2010, that's all we've had is a bull market. We've had a couple corrections along the way, but it's still a bull market. You can't really evaluate what we're doing until you've seen a full market cycle. And that means a bull market and a bear market. And I like to always look at what happens after that, because not every bull market's the same and not every bear market's the same. So looking at how things reacted and how things acted, the longer you can look at it, the better it is. So evaluating our performance on just the last 5 years is really not fair, because by design, we cannot outperform a buy and hold strategy because we will deploy some risk management. Now let's look at the overall goals of our programs. Income allocator, which is shown in green, and also tactical bond there, which is kind of the bluish colored line there. Their overall objectives are to provide returns higher than a CD or a money market. In fact, we've oftentimes called that the CD replacement fund. It tends to be low risk in the whole scale of investment possibilities out there, but it can have some risk. It's not designed to have no risk and no losses. And throughout our history, we've had losing months. We've certainly had losing quarters and a couple of losing years along the way. So losses can happen. But if you look at what its job is in a bull market, which is to provide returns greater than a CD or a money market, it's done that. They haven't been spectacular, but we still have positive returns. If you look at since 2010, the returns on the CD have been close to zero. Now, looking at the other end of our investment spectrum, which is enhanced growth, the goals there are to provide stock market-like returns, not match the stock market returns, but stock market-like returns. In other words, we want to provide returns greater than our income programs, greater than a bond investment will do, but knowing it's impossible in the bull market to beat it unless you're invested 100% of the time, 100% of the days. You got to be all in if you're going to at least match the market or beat it. Enhanced growth won't do that. There's corrections along the way. There's risk management strategies that kick in that cause us to sometimes get out. But if you look at what our actual benchmark is, and this is something important on this chart, it's the aggressive allocation index. And I'm not sure what you call that color on there, but it's that other line there, that Morningstar aggressive allocation. And that's the whole universe of stock investments. And that's what enhanced growth is trying to use when it looks at things. And you could see in 2011, at the end of the year, we started to see this divergence between the overall stock market, the aggressive allocation segment of that, and the S&P 500. So in other words, if you've had any sort of diversification, whether it's with strategic equity or somewhere else, you've underperformed during this time. Now there's something that you have to really understand when you look at this. We've studied market history and we've studied all kinds of different markets. There's two things that can happen when you see one market do much better than the rest of the overall market. And that's either the rest of the market catches up or the market that's outperforming falls back down. Either one is great for enhanced growth. Obviously, we prefer that the rest of the world catches up and we just get into those other assets out there, small caps, international stocks, some of the specific sectors that have underperformed, let them catch up and make some money. However, enhanced growth has done a good job in that full market cycle again of being there with capital ready to deploy when those valuations look the greatest. But again, it's important when you look at this, you cannot evaluate us just on a bull market. It's not going to ever beat the bull market performance. That's just how it works. You got to look at a full market cycle. So to do that, let's take a step back and look at the returns since 2006 for some of our programs. Now this, you start to begin to see where SEM can add value. One thing I really want to point out is the magnitude of the losses. You look at the losses of the S&P 500 and the aggressive allocation and even the multi-sector bond index, and you can see they're much greater in all cases than the SEM programs. Now, while the benchmarks have had one of the longest bull markets in our history, keep in mind, this is more like a full market cycle. Now, notice we didn't outperform by a lot, but overall, we've pretty much matched or exceeded our benchmarks. So when you look at a full market cycle, even with this tremendous bull market that we've been with QE and everything else that's going on, even with the losses we've had to take over the last couple of months, we're still doing our job, which is looking at that full market cycle, providing returns greater than the benchmark, more importantly, the risk-adjusted returns. So we're trying to lower the volatility in the portfolios, which then when you look at the full cycle allows you to beat the benchmark. So to really understand that, you have to know what a full market cycle looks like. But as I said earlier, I like to look at a couple of bull markets and preferably a couple of bears, but for a lot of reasons, I choose to kind of chop off and ignore the 2000-2002 bear market. Some people say the market's changed. We've seen some of that. We've seen some things that haven't changed since then. But one thing we know for sure, a 1990s type tech bubble is probably not going to happen again in our lifetime, which means the after effects of that bubble probably won't happen. So let's just look at the performance of our systems since the end of 2002, since the tech bear market ended. Now, look, we realize a lot of our clients have not been with us during this time, but it starts to show you a little bit about what strategic equity management has done, can do, and we believe will continue to do as we look at a much longer term time horizon. The most striking thing to me in this chart is, had you invested in a buy and hold strategy at the very end of the tech bear market, say you jumped in at the end of 2002, whether it was a buy and hold stock portfolio or a buy and hold bond portfolio, by 2008 you had less money than a CD. And this is with the big bull market we had during the housing bubble. You ended up with less money than a CD. Now compare that to strategic equities programs, and you can see that's the value added. That's why you're with active management. You're not with us to try to beat the market at every turn. We just can't do it. Every investment has good times and it has bad times. We mentioned in our last portfolio update that we've studied all sorts of different indicators, and the best one, if you're looking to provide risk-adjusted returns, lowering that volatility, is to use a trend following method. What that means is we can't get back in until the market's turned around and it looks like a new trend is developed. We can't get out until it looks like the market has rolled over and a new trend is developed. That means there's going to be some bad trades. There's going to be times where we don't get out at the top, or sometimes even close to the top. There's going to be other times where we don't get in at the bottom. You look at what happened in 2009 at the bottom. We didn't jump back in right away, but because we had capital there to deploy, we ended up providing very strong risk-adjusted returns. And that becomes important because we know that people tend to bail on an investment when it gets too volatile, when the losses start to pile up beyond whatever that tolerance level may be. So it's really important to understand that with trend following, we're going to have times where it's just wrong. Now we have other systems that we use that are kind of ancillary components of that, where they can buy when the market's gone down, they can sell near the top. But some things, sometimes you sell at the top, what you think is the top, and it just keeps going. Sometimes you sell when you think it's the bottom, or you jump in and buy when you think it's the bottom, and then it goes even lower and then even lower. And that's something that we know our clients won't put up with. I wouldn't put up with it. That's just something that we're stuck to deal with. So what happened here, with our systems is, kind of normal. If we've looked back and we've studied our past history, and typically near the top, we will have a lot of bad trades. The volatility, the tug of war you start to see, we just, our systems can't handle that. But we also haven't found an indicator that says, oh, here's the market top, you better just stop trading, get out of everything and go to cash. And that if it's out there, we would probably purchase it. But then if somebody's trying to sell something like that, it would stop working, because that's how the market works. So I'd love to find an indicator that says, okay, we're near a top. We're working on things. We're constantly working on things. We're working on new systems as we speak. We're also looking at our systems, what went wrong, if this is normal, if we need to tweak anything. Though so far we've just found this is normal. It's frustrating, but it's normal, because we cannot call the top in the market. We cannot call the bottom in the market. We're stuck dealing with what works most of the time are these trading systems that wait and see what institutions do. So what happened is the institutions like us had a hunch that things would get a little risky, that they probably need to look at getting more defensive. So they got out, they capitulated. We saw that the big selling in August and September. Our systems, we wrote a little bit of that down. Some systems enhance growth more than others. But then we saw this furious rally come back. And what we started seeing happen right at the end of October, the beginning of November, was the institution said, oh no, we might have been right, but what if this market takes off and gets away from us? So they started piling back in. Our systems are designed to do that, so we followed suit. Now, hindsight, we'll know if it keeps going lower, what the results were. Let me tell you, our systems are close to selling out again. They're most likely not going to write it down another 10% like they did last time, unless it happens over a 2-day period. And then if so, that's something we'll have to deal with. But what we mentioned in the last portfolio update is you tend to see a big rally, a 10% plus sell-off, and then that final blow-off top. This blow-off top may not even be over yet. I mean, we're talking the market's down, 3.5% as we record this from the recent peak. It's still, 4 or 5% off the highs. It could still try to make a run towards those old highs. If so, we're positioned for it. Our systems will look for signs of strength or weakness for that sign of a top, but it's not going to get out at the exact top. I wish it could. It just can't. But the defense is much closer to taking the field than it was, say, in August or September. And that becomes important. We are in now. If it does keep going lower, we tend to get out. Our bond program's same way. We still have potential to make money, but don't know. It may not quite be the time to be invested. We've seen some minor selling this week in our trading systems. We have some positions that could actually make money if high yields go a little bit lower via treasury bond investments. I don't have that crystal ball, and we won't know till we have hindsight, to our benefit. But just know this is normal, and it's a frustrating time to be invested in us, and I understand that. And our own personal money, my family's money, friends of mine, that I see every week at church, and various activities, their money's in there, and it's painful for me to go through any sort of losing period. It's painful to see people losing faith in what we do. But again, this is unfortunately normal. But unlike other investments and unlike other managers, we have the tools in place where we don't have to go with my emotions in order to decide what we should buy and what we should sell. We've looked at this chart many times. I think I started it with our newsletter. We've included in our economic update and our portfolio update just from last week. And I want to take a little bit of a different take on this. We're all human. I've mentioned a lot of the emotions that I've been feeling. I'm no different than anybody out there. Nobody likes to lose money. And as you lose money, you tend to start to see emotions really taking over. Same way when you're making money, maybe not to the same extremes, but money causes us to be emotional. But the reason we use mechanical systems is our ability to test them through different types of markets to then allow us to go back and look and say, well, is this normal? Is this abnormal? What can we do? Do we need to do anything? And again, so far the data is saying we can't prevent what happened. We also have not found a better way to do it. But it's also things that have happened throughout our history. Some of our worst periods have been at that turning point of the market where we've had losses greater than the market at the turning point. And then as things settle out in what we call normalizing, then our systems get back and they get in the groove again. And we've seen it happen time and time again with our systems. That's either fortunate or that's unfortunate, depending on how you want to look at it. I'd love to have great news and say, you know what, we figured it out. Here's the magic formula we're going to use going forward. One thing I've learned, and we've been here, our company's been here 23 years. And I've been here 17 of them, which means I've seen every bear market that's been in existence for our company. Is we, tend to see clients, advisors, people lose faith because there's somebody out there who might be doing really well. I've looked at a lot of the active managers, and in fact, we're on a couple of platforms with other managers, and ours are one of the best performers year to date as far as active managers go. I don't like doing that type of relative comparison. I would like to say, hey, look, we have gains, we locked them in. Unfortunately, it's not the case right now. But What I've seen though is things that work in markets like this tend to not work very well in normal markets. So even if I were to go back and say, here's the magic formula that would have made 2015 spectacular, chances are it would not work in any other period. I found a few things, a few indicators. I thought, oh my gosh, I finally found that magic formula, tested it in 2013 and 14, and we would have lost double digits. So keep that in mind. It's something that we continue to strive for, but we yet to find it. So I'm getting sidetracked here. Back to emotions. We don't want your emotions running away from you. We want you to use objective data like we are. Now, you don't want me investing emotionally either. A lot of times my hunches end up being right, but I'm not having to put real money forward based on those hunches. Also, my hunches tend to be quite early. As some of our readers know, there's structural things that should have been clobbering our economy and our stock markets all along. You don't want me investing on my hunches, because what happens when a portfolio manager has a fight with their wife? Not that I have a fight with my wife very often, thankfully, but let's say our kids. How's that going to frame the way you're looking at the data coming in? Or what if you just got off the phone and one of your largest clients called and said, you know what, I'm going to go to cash, or I'm going to go to this other manager who's doing better? It's going to taint how you evaluate the market. The beauty of what we do is we can look at objective data. We can structure portfolios based on the big picture, based on more normal markets, and have the confidence that things aren't getting out of whack. Have the confidence that if things do get out of whack, we can adjust for that. We can take those systems offline. People have been around for the last 5 or 6 years, know there's plenty of systems that we've had to take offline. So that's something we can do. But the important thing to understand is we can set you up for a portfolio that's designed to last over the long term. We can help you prevent yourself from falling for some of these emotional biases shown in this slide. We can just basically help you decide if you're in the right portfolio. So before you use the last few months, even the last few years as your evaluation, take a step back. Look at the big picture. Look at a full market cycle. Every system has good times and bad times. Every program has good times and bad times. Typically, if it's in a bad time, and it's a solid long-term investment, like I believe strategic equities programs are, as we've proven. We're still here after 23 years. Not a lot of active managers can say that. These systems, a lot of them, our core has been around for that long. So don't give up faith just based on the last 2 months, 2 quarters, 2 years, whatever that time frame may be. Look at the full market cycle, because on the other side of a bad time tends to be the good times for investments. It's the same with buy and hold. It's the same with active management. Buy and holds have been on a really long streak of good performance. Are you really going to jump into something that has had almost an unprecedented length of outperformance? Or are you going to look for things that have a much more solid basis, a much more likely chance of meeting your investment objectives over both types of markets, both bull and bear markets? So I just want you to consider your own emotions, realize you need to make decisions based on data. We can help you. If you're an advisor, we can walk through specifics via Tim or Jim. If you're a client, speak with your advisor. If you need to do an additional conference call, we're here for you. We're not going away. Again, we've seen this before. It's never fun. It's a lot of sleepless nights on our end to prevent, hopefully, sleepless nights on your end. So just ask you to keep your emotions in check and realize that, if it's frustrating to you, it's way more frustrating to us, because we're the ones making those decisions. We take this personally when we go through a difficult period like this. Finally, as always, I've covered a lot of information in a relatively short amount of time. It's always longer than I intended. This was supposed to be a 5-minute portfolio update, but I'll go into it. I'll put my emotions out there every day. I'll look at the data. I'll tell you what's going on in our portfolios. Best place to start is our website every day. If you haven't been there yet, start at strataequity.com. Register. Click on the confirmation email, come back, log in, look for the Traders blog. That's where you'll see my stuff. If you don't want to register, we do a weekly podcast we put on there over the weekend. I also will put any economic updates or other things there on the website. I hopefully won't be back unless it's to give you some good news too soon. But if necessary, I'll be back and continue to check these pages. Subscribe to my YouTube channel if you want to find more updates. But no matter what, up or down, I truly appreciate the trust and the confidence you've placed in me, and it's not something I take lightly. And I'll continue to work hard to earn it and give you that justification that you made a good choice.